Now, the European Central Bank left interest rates in the main parameters of its asset purchase scheme unchanged. The decision was expected and keeps unprecedented stimulus in place to aid the bloc's slow but steady recovery. The ECB kept its rate on bank overnight deposits at minus 0.40%. The main refinancing rate, which determines the cost of credit in the economy, was unchanged at 0%, while the rate on the marginal lending facility remains at 0.25%. Facing low inflation and weak growth, the ECB last month extended its €2.3 trillion debt purchase program until the end of the year. It's promised substantial accommodation and extended market presence. ECB President Mario Draghi is set to hold a news conference this week. Now, Mariam Zaidi joins us live in Brussels with more on this. Mariam, welcome to the show. Now, the ECB's decision today was expected. Give us some insight into the ECB chairman Mario Draghi's tone at today's meeting.
Hi, Oche. Well, speaking at his press conference in Frankfurt earlier on today, the European Central Bank President Mario Draghi announced that their monetary policy for the Eurozone, the package of low interest rates and bond buying, is to remain unchanged. This comes despite the fact that there has been a rise in inflation in some Eurozone countries, namely Germany. Now, ahead of the ECB's Governing Council meeting, Germany, where inflation has reached 1.7%, was trying to put pressure on the ECB to change tact and raise interest rates. It didn't happen. In response to Germany, the ECB president said that the increase in inflation didn't do enough to convince the ECB to change its policy for the Eurozone because the Eurozone economy as a whole has not recovered. We can just use examples of, say, Greece and Italy. In Greece, inflation is at 0.02% and Italy is at 0.49%. And the increase in inflation could also be put down to an increase of the price of oil. So Draghi's advice to German savers was be patient. He said as recovery firms up, interest rates too will go up.
Well, Maria, how did Europe's stock markets react today? We saw them stay sort of in negative territory. How are you seeing investors reacting, of course, to the ECB meeting?
Well, the decision today was largely expected, so the market wasn't really surprised. There was the usual volatility where the euro lost some ground against the dollar when Draghi did announce that there would be no change in policy. But the question is, can the ECB policy stay this way for years to come? The problem is the differences between the European economy. So southern Eurozone countries like Greece and Italy need the ECB policy, but not Germany. 0% loans are not good for older German savers who are losing money twice. What we mean when we say this is that they firstly have low interest rates at the bank and then inflation is around 1.6%.
Well, Mariam, let's shift focus and talk about the looming Brexit. Of course, Britain's finance minister did warn EU officials that the UK would be forced to find different ways to remain competitive without a comprehensive trade deal. So what direction can we expect Britain to go now? And can we expect to see more foreign direct investment?
Sure. Well, in leaving the EU, the UK will need to negotiate trade deals country by country, and this could, well, take decades. So what we've seen ahead of formal EU exit negotiations is Theresa May flexing her muscles to convey a position of strength for the UK. Now, the British Prime Minister did unveil her Brexit plan this week, which was largely welcomed by EU leaders. But until Article 50, of course, is triggered and the UK starts its formal process of leaving the EU, it's really hard to say what kind of deal they will get for with the EU. So, you know, really, how does the UK stay competitive outside the EU? Well, the UK Chancellor Philip Hammond said recently that the UK must stay competitive at all costs. He said that the UK would make aggressive cuts to business taxes and ensure UK-based firms remain competitive in the face of EU tariffs. So would any future economic model make the UK a tax haven? Well, it could be the case. Hammond said that if they are forced into something because they don't get the right deal with the EU, they will cut corporation tax, essentially to make the UK attractive to foreign companies and foreign investment. But would that actually work? Well, tax havens seemingly only work for small countries. Big countries would need to attract lots of companies to balance the cost of leaving the EU market. Now, would that be a problem for the UK? Well, the UK has historically been one of the top EU countries when it comes to foreign direct investment. Now, according to figures, the value of foreign assets held in the UK is over £1 trillion. But with uncertainty, of course, over Brexit, we are seeing signs that investors are viewing it as less attractive. Back to you.
Well, many thanks, Mariam, for those insights. Mariam Zaidi joining us there in Brussels.